Okay, let's think about this in terms of welfare analysis now. Remember, we've got at the initial equilibrium point where the marginal benefits equal the marginal costs at equilibrium. The consumer surplus is the area under the demand curve up to the equilibrium quantity and above the equilibrium price. The producer surplus is the area under the equilibrium price up to the equilibrium quantity and above the supply curve. So in this case, again, we're maximizing our total economic welfare, the consumer plus the producer surplus, and we're allocatively efficient. Now we're going to impose our tax. So we impose the tax, and in this case we're going to make it a sales tax. So we impose the sales tax. It pushes the supply curve upwards to the value of the tax. The new equilibrium is at 105, and that's the price paid by consumers, 105. However, the after-tax price that the buyers effectively receive, this is after tax, is $95 because it's 105 minus the $10 per unit tax. It gives them 95. So when we look at the welfare analysis now, we can see that the consumer surplus has been squished up into this tiny area here. The area under the demand curve up to the new price, up to the new quantity that is supplied and purchased, 2 units, and above the new price that is paid by the consumers. So that's the consumer surplus. What about the producer surplus? Well, the producer surplus is the area above the supply curve up to the new quantity supplied and below the price that the firms receive effectively after tax, which is $95. So that's the producer surplus. So what about this area here? Well, that's still, so part of it is consumer surplus, part of it is producer surplus. That still exists in some sense, but it's been transferred away from the consumers and producers and has been redistributed to the government, who will then use it in some way or other. Note that we've also got a deadweight loss area because of the imposition of this tax. So we know that economic welfare is not being maximized due to the imposition of the tax. Both the consumers and the producers lose out, and overall the market loses economic welfare. But bear in mind, as I said earlier on, this doesn't mean that the society overall necessarily loses out due to the creation of this deadweight loss. If the tax revenue is used to eliminate a deadweight loss in a different market. But we don't know that in our story here. We don't have any motivation for the government to do what it's doing right here in this story. But it's certainly a possibility that overall the government could be reducing deadweight loss in the society as a whole.